If you've ever sold an investment at a loss and wondered, hey, can I get anything out of this train wreck? The answer is yes. That sad little red number in your brokerage account might just lower your tax bill. Or maybe you bought that rental home and it totally went under. Either way, you can save on taxes, but only if you know how to do it properly. So today we're covering essential things to know about tax loss harvesting, what it is, how it works, and how to use it strategically to keep more of your money away from the IRS.
So today, Spencer, we're going to be talking about tax loss harvesting, and we'll go through some essential things that you need to know. But from a conceptual framework, what even is tax loss harvesting?
Well, it's selling investments at a loss to offset gains in your portfolio. Generally speaking, investments over time, they're going to go up if history is any guide in the stock market. So we want to be able to offset some of that gain. And then there's also ways that you can even sell investments at a loss to be able to offset some of your regular income, which is what we'll be talking about as well.
Great. So let's start off. How do you use losses to offset capital gains?
Yeah, so you sell at a point when an investment is down. Now, you've got to recognize that sale. You can't just look at it and say, hey, I've lost some money over here. This will offset. It actually has to be a sale. So that's the first thing. And it has to be done in the calendar year. There's not a capacity like with an IRA contribution where you can do it anytime up to April 15th of the following year. No, it's got to be done in that particular year. So you made some money over on another side of an investment, and you sold that, you recognize that gain that same year, you've got to sell something to offset that as a loss if you want to use tax loss harvesting.
Okay, so let's take an example maybe and say, I sold a business at the very beginning of 2022, and I wanted to invest that money in the market, whether it's stock or bond. 2022, as we know, we've dubbed it an investment winter. Stocks and bonds were both down. So let's say I closed and the sale of my business netted me $100,000 of capital gains.
Right.
And then over the course of 2022, if I put things in a portfolio, those investments, let's say they drop 20%. How do I then, how does that all work?
Well, first of all, it needs to be in an unqualified account. You know, if you took some of those earnings, some of the what you had there, and you slid it into some kind of a retirement savings account, then we've got other issues there that we've got to address from a taxation standpoint. But what would generally need to happen is you book the gain in 2022, maybe early in the year. You need to also book the loss. So you need to sell the investments actually. So if you've seen 20% drop, it's that financial judo of sorts. You turn that loss and you turn it around into something that's actually helpful for you.
Okay, that's helpful. All right, so let's talk about the deductions against ordinary income. So we talked about it on the capital gain side. How do you work this against your ordinary income?
So the IRS allows you up to $3,000 on your tax return to be able to deduct that against ordinary income. So let's just say you were unfortunate enough to buy Rivian at the high, and then you sold it and you had a loss of $6,000. Well, you can take $3,000 there and you can apply that to your ordinary income. And this can be really, really helpful for professionals, for folks that have a high level of income. Let's just say that you're in the dreaded 35 or even 37% marginal tax bracket. Why, if you have $3,000 that you can offset there, then you can save over $1,000 just by that, recognizing that loss. So up to $3,000 again every year. Now, if you don't use all of your losses, you can carry those forward indefinitely.
Okay.
So let's just say you booked that $100,000 loss, your investments went down 20%, and you had $80,000 of loss in that year in 2022. Why, you have $100,000 in gain, you have $80,000 in loss. Well, now you're only going to have a net gain of $20,000. But let's say it was different. Maybe you had $100,000 of gain and you had $120,000 of loss that you could recognize. Well, now you've got a net $20,000 loss, and you can recognize $3,000 of that against your ordinary income, meaning that you would have $17,000 of loss that you would carry forward into the next year in that circumstance.
Okay. So then theoretically, you could continue carrying on those losses. Let's say the next year there were no realized losses that I had. I can still carry forward that $3,000 until the rest of that $17,000 in that example is used up. Is that correct?
It's true. And we saw this oftentimes with clients that came to us after the tech bubble burst. And what would have happened, they may have put money in right towards the end of the technology bubble right before it burst, and the NASDAQ went down almost 80%, over the course of a couple of years, and the overall stock market dropped almost half. It was cut in half, basically from the technology bubble bursting, Enron and WorldCom, those accounting scandals, and then 9/11, that triple whammy. So if a client put in $100,000 right near the peak, say in early 2000, and it was cut to $50,000, why, we've got significant losses sometimes that were booked there. And because it took a long time for the market to recover, and sometimes they weren't quite as aggressive thereafter, they got gun shy when they came, to us, let's just say, and built a more diversified portfolio. Sometimes we were using those losses to offset the gains going forward for a period of over a decade. So it can be carried a long time into the future.
Yeah. And we do need to say this is under current tax law.
Sure.
Anything can change with tax law. And so as we are recording this is what is true about carrying forward losses. We don't expect that to change, but we never know if the tax code is significantly simplified. Things can change at any moment. So talk us through the wash sale rule. What is a wash sale?
So a wash sale is basically the IRS way of saying, no, we're not going to make this tremendously easy for you. So you're not able to just sell, let's just say you had a loss on Apple stock, you're not able to sell it and then the next day rebuy it. So recognize the loss and then put it right back in. So the key phrase here is substantially identical. So you want to, if you wanted to just reposition to be able to book the loss but keep the investments mostly the same, then the IRS will generally allow that. But if it's substantially identical, that is the same security, then they're not going to allow that. So an example might be, let's just say you had an exchange traded fund that was managed by Vanguard that comprises the entire US stock market there, and you sold it because in 2022 that was down and you were able to book a loss. You might be able to then take those funds and buy a similar type of investment, some kind of a US stock mutual fund or ETF, but just not the exact same one there. So it might even be a total market fund. It might even be an index fund, but it wouldn't be the same fund. You wouldn't want to do the same fund. So because if you do, then the IRS is going to come after you and they're going to say, no, that's disallowed. So, again, you sell that same Vanguard fund and rebuy it 2 days later, you say, nope, that loss that you've booked is disallowed.
Right. All right. So you talked us through this idea of selling the Vanguard total market, buying maybe another one that is similar. What if we tried to do this with an individual stock? Let's say we used Apple instead, and Apple took a big hit. You have a loss. You wanted to book it and then buy it the next day. How does the IRS treat then your basis at that point?
Well, they basically just don't give you the advantage of selling and recognizing the loss. They're going to keep the basis the same as it always was and just say, well, we're not going to allow you to book that loss and lower the basis there. So again, it has to be sold. Watching it go down on your screen doesn't count. Hope is not a tax strategy. You've got to actually do the work to make this happen. The other thing that you can do, of course, is you could wait 31 days. So you could sell the Apple stock, wait 31 days. Now, Apple's going to move around probably a bunch in that time, and then buy 31 days later. So you could buy the same exact thing, but you've got to be out, have that pause for a period of time, which most people don't want if they want to maintain that market exposure, particularly when we see downturns. Oftentimes, there will be a bounce back that they won't want to miss there.
Right. Okay. So let's talk about this in maybe a Roth account or a 401k. Is there opportunity to tax loss harvest in those accounts?
The difficulty is if you bought Rivian at its peak with $20,000 in your Roth IRA thinking this is going to make me a Roth IRA millionaire in the next couple of years, it's actually just a regular unharvestable tragedy. You're not able to get any kind of tax benefit from that. You've already paid the tax on the funds that went in. It's either going to go up or down whenever you take the funds out. Again, provided it's a qualified distribution from your Roth IRA, you're not going to pay tax on it. So there's no real opportunity in a Roth IRA. Same thing in a traditional IRA. Basically, you're not going to be able to harvest that loss.
Okay. Let's talk about timing. And maybe not as much in terms of, okay, is it January 1st? Is it January 12th that I do this? But in terms of market cycles, when is it advantageous to do tax loss harvesting?
Well, you have to have a loss.
Yeah.
So there's a couple different things that we could say here. First, in a volatile market, typically you're going to have some investments that go up and some that go down. And so you're going to have an opportunity to book that loss. Yeah. The other opportunity set that you have there is if you have a lot of different investments, if you have a lot of different stocks. So this is one of the things that if we look at direct indexing, which is kind of getting its moment in the financial press, if you own all of the individual stocks of the S&P 500, there are going to be stocks that are down at any particular moment, even if the market is way up. Right. So where this is more difficult is if we have kind of a slow, steady climb for a market, and let's just say it's in stocks generally speaking. Let's say that you've diversified through ETFs or mutual funds, and you see all gain there, then there's really no opportunity to do that tax loss harvesting.
Yeah. So let's talk about that, the idea of mutual funds versus ETFs, because they're a little bit different in how they work their capital gains, how they embed them within their fund. How do we think about funding, or how do we think about tax loss harvesting with those two types of investments?
Well, ETFs are a little bit more easy to predict where they're going to be. Typically, they're only going to push out dividends to their investors. There's not going to be capital gains, generally speaking, pushed out within an ETF. Mutual funds are a little bit different because if there's turnover within a mutual fund, oftentimes there will be a capital gain distribution, which will increase the basis. So there are mutual funds that the managers are very, very focused on tax consequences and keeping an eye on basis and such for investors. But most of the time, that's not the biggest thing that a mutual fund manager will be looking at. So generally speaking, we would tilt towards trying to make investments in an ETF just because their structure is a little bit easier to manage in a non-qualified account. In a IRA or Roth IRA account, it doesn't really matter in that same way. But in those non-qualified accounts in particular, there are some advantages to ETFs because we can look at it and say, okay, here's where we know the basis is. It's probably not going to change all that much here in the future. We're just going to receive some dividends and not capital gains distributions. And then if we see the account go down, see that particular investment go down, then we're able to harvest that. On the mutual fund side of things, if there's a big capital gain distribution, for instance, let's just say in 2021, we saw a big movement upward in a number of different mutual funds and had a nice year in 2020. Well, they might push out a capital gains distribution that raises the cost basis. We have to be careful with that because if the cost basis then has been raised and we've already paid tax on that gain, basically, well, now we have a high basis. So the mutual fund then drops, let's say in 2022 by 20%, which was not uncommon. Well, now we've got an opportunity to do some tax loss harvesting on the mutual fund. But actually, we would have preferred if we just had the greater clarity of using an ETF to begin with.
Right. Okay, that's helpful. So what are maybe some of these other trip ups that we often find with tax loss harvesting, this idea of transaction cost or slippage?
Yeah, one of the things, we never want to put the cart before the horse here. It's an opportunity if we believe that we're going to need to reposition in a non-qualified account, go ahead, take some of those losses. It can be a great opportunity, but we don't want to just sell a fund that might be in positioned very, very well. Let's just say we don't want to sell an individual stock that has a great opportunity for a rate of return that's high going forward just to be able to book that tax loss because we don't know when that rebound might happen. So we want to look at this and say, is there a way that we can not sacrifice the diversification, the long-term approach that we're taking, but just around the margin, save some in taxes, basically. That's the goal here, rather than changing things up, because there are frictions that are there, like you mentioned. We don't want to necessarily sell a mutual fund that might cost $25 to sell if there's only a loss on it of $500. For instance, the savings there, by the time we sell it and then rebuy something else, it might be, you might be underwater even. So we want to be careful about that. The bid-ask spread costs as well on some of the thinly traded individual stocks, we've got to be careful with that too, because those can eat into the tax benefit, certainly, that we would have if we did a tax loss harvesting strategy there.
So we've heard the phrase, don't let the tax tail wag the portfolio dog. What does that even mean, and how do we address that?
Well, one of the things that we want to come back to is we need a level of humility here. We don't even know that this is going to be in a client's best interest for certain, because we don't know tax policy going forward. So if taxes were to rise down the road, this might not be the best approach, because what we're doing is we're lowering the basis. We are harvesting losses and we're lowering the basis. So if we had a scenario where the US government said there's no longer going to be a step up in cost basis when you pass away and pass these resources on to heirs, that would be a consideration. If we have a higher tax rate on long-term capital gains in the future, then this might not be the best strategy there. So we have to have a level of humility here too. I think we also have to recognize that there's going to be some time out of the market. Even if we're selling one and buying another, usually funds are out of the market for a day. Sometimes in ETFs, you could sell one and buy another, and they're only out of the market for a minute or two. But there is some time out of a market. And I think the final thing is, are we really replacing truly equivalent pieces of a portfolio? Yeah. So if we're replacing a total stock market fund, for instance, with another fund that might be a sector fund, or one of your favorites there, it may not actually be apples to apples there. So we never want to take those considerations and push them to the side. We want to recognize that there may be some gains, there may be some benefits that we can use with this approach, but there's always some trade-offs, and we have to be comfortable with those.
Right. So as we close out today, what are maybe some steps that we can take as we think about tax loss harvesting? Obviously, working with a professional financial advisor is one, but what are some of those other things that we could consider if this is a strategy that clients want to implement?
Well, I think, like you said, make sure your advisor knows that you have a capital gain that you're kind of grappling with there if you're looking to do tax loss harvesting to offset it. I can't tell you the number of times that we have a client that will come to us and say, oh, I had gains over here in some other account that we weren't aware of, or some other field that we weren't aware of, and we didn't have the opportunity to take a loss on some of their non-qualified gains. So you want to make sure that your advisor is aware of that, or your CPA is aware of that, can help you kind of navigate that in that calendar year. Again, don't bring it to them in February and say, hey, I've got a tax bill. How can we address this? Because there's not going to be an opportunity. So we want to make sure that there are lots of different ways that you can do this. If you're working with an advisor, obviously he or she can look at things and be able to say, okay, you've got this amount of gain here, you've got this amount of loss here. Here's a strategy that we can use to harvest some of these losses. Or if you're looking at your statement or your online platform and you can see those details with respect to the amount of gain or loss that you might have, then you can implement that yourself.
Spencer, any last thoughts on tax loss harvesting before we close out today?
Well, there's a lot of nuance to it. It is possible to knock down your tax bill. A lot of people really focused on knocking down their tax bill. Particularly with folks that either have a lot of capital gains or have a marginal tax bracket that's really high. This can be a strategy that can save several $1,000s or even tens of thousands of dollars if done correctly on an annual basis.
Great. Well, thanks for walking us through tax loss harvesting. Clients, if you have any questions, we would love to discuss this with you. As always, leave comments or questions down below. And again, take this information to your financial advisor. Don't just act on what we said. Really take this in consideration of what is true about your specific situation with your advisor. We look forward to talking with you again soon. Take care. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.